After a difficult January, it's been somewhat of a rebound in February for the global equity markets. If we look at the MSCI World, which is an index of global developed stock markets, it's up 4.8% in the month, which is a fantastic return from global developed market equities. But if we look a bit deeper, the picture isn't quite as clear. The FTSE 100, the UK equity market, has had a great month, up over 5%, and it's been a similar picture for both Europe and the US, with solid returns of over 4.5% in the month. But for Japanese equities, it's been much more difficult, and the Japanese equity market returned -0.7% in the month. In the portfolios, we continue to favour the US, and we like the UK, and we still have almost zero exposure to Japan, so February would have been a good month for us. Elsewhere, if we look at emerging markets, it's also been a mixed picture. The Chinese equity market is up over 2.5%, and the Indian stock market up over 3%, but Latin America posted a negative return. Again, the regional differences are quite stark some months. If we consider China as a whole, we like the long-term story for China, but short-term, and by short-term I mean a few years, there is a new leadership in China who is trying to undertake reform, and reform is difficult. And it certainly seems that some of the banks, with their non-performing loans, bad debts if you like, are going to have some problems over the coming months and years. We may have some level of financial debt crisis in China. Consequently, we're not heavily weighted towards China, and we don't particularly like Chinese equities in the short term. Now, the crisis in the Ukraine simply reminds us that crises can occur, and when they do, volatility returns to equity markets. Certainly there's been a sell-off in the equity markets with the crisis, and we remain broadly exposed with lots of diversification to ensure that not all the portfolio is affected at the same time.